In this take-up video, we're going to look at 27. So this is the first time really that we've done adjustments in a traditional sort of accounting cycle manner. And we're going to take it up because at this point in the course, the content's starting to get a little bit juicy. There's a fair bit of it. And I usually have a lot of questions the first time we go through this. So I'm going to do a take-up video to help all students, but especially those that are taking online courses in intro to accounting. So let's go through 27. When you open it up, make yourself a copy, and the first thing you have to do is read the instructions. And you're going to understand that it's a small accounting firm, and most importantly, when you're doing an adjustment activity, you need to know what the period you're adjusting for is. Some companies do it quarterly, monthly, and this one is doing it yearly. So when you look at things, you're adjusting for a year. So for example, if it's an amortization expense, the formulas will give you the answer for amortization expense for a year, so you don't have to do anything with the answer. But if it was a month, for instance, you'd have to divide by 12. So let's get started. I'm just going to run. This is after we're done adjusting for our financial statements. This is the information we need to do our adjustment journal entries. And remember, nothing actually happens, nothing gets into the books unless it's journalized. Every entry at the start of the business, all your adjustments, when you're done the accounting cycle and you do closing entries, which you haven't learned yet, everything gets in there by a journal entry. If it hasn't been journalized, it hasn't happened in as far as accounting is concerned. So click this, and in every new file, as with every activity like this, you've got to authorize the file, which by now you should know how to do. So we'll skip this step. So I've authorized the file to run these little scripts that I've programmed, and so I'll just fire this off, and over on the side now, we'll see two options. I'm going to go right to my description, and our first adjustment bit of information is on December 31st. So here we go, December 31st. All adjustments are usually done on the same date. The building uses a declining balance rate of 3%. So once you get really cozy with adjustments, you just know what needs to be adjusted, and all you really need are the specific details that go into a formula or something like that, right? All long-term assets except land will have to be adjusted. So the building is going to be adjusted for amortization, and it's telling you the method's declining balance and the rate's 3%, and you just need to know that that's 3% of the book value. So you need to go to your starting balances, and starting refers to the start of this assignment. So in other words, the very last regular journal entry has been done. Everything's been posted, and this trial balance is what you've got at this very moment before you do your first adjustment entry. That's why there's revenue and expenses in there for the year. So our building is $117,400. So we need that number, and you can actually just copy it right from the side panel here. So we're going to go amortization expense. A little too fast. Amortization expense. And we're going to credit the accumulated amortization for the building. And that expense is book value, which is the $117,400, minus all amortization to date. And that's this number, not all those numbers. This number right here, $10,252. So we're going to subtract that. Didn't pick that up. Copy that number, paste that in. That's our book value. So our book value is about 107,000, right? And that's what we hit with a 3%. And we don't need to divide it by 12 because this is an annual amortization period, right? According to the instructions at the beginning. So that's our answer, and we're just going to use that number right here. Now, we're not doing this multiple times, so I'm not going to bother to round it. But if you had to make, if it was like a multi-year assignment and I had to do that adjustment 10 times, we could be off without rounding. But in this case, you don't have to because you're only do it once in this whole assignment for that item. So the next one, December 31st, is going to be another adjustment. So we did this one, check. So we're doing this one now, office equipment. And it's telling us it had a useful life of 11 years and a scrap value of $400. Well, that's the straight line method. So 11 years, $400 for, what was it? For office equipment. So our equipment is $41,400, and we're going to have the same. We're going to have amortization expense, and now we're going to accumulate amortization for office equipment or just equipment, whatever. So this is going to be $41,000, again, $41,400 minus this ridiculous number I'm going to copy and paste, which is all, it's straight line. So it's minus the salvage value, the scrap value, right? Which was $400, and it was 11 years. So we're going to subtract $400 for scrap value, and we're going to that's the value to be amortized, and we're going to spread that over 11 years, I believe it was. Yes. So divide by 11, and we get our annual amortization rate. And that looks like it's correct, so we're done. Our next adjustment here is going to be for, what is it? The vehicle, 18% declining balance. All right, no problem. We can do that. So this is amortization expense again, and now we're accumulating it for the automobile. And the automobile is got a value of $47,200. So that's going to be $47,200. And we're subtracting all the amortization to date on that to give us the book value. And our book value then is this number, which we are going to multiply by the rate they gave us. I believe it was 28% or 18. No, it was 18%. So we're going to multiply that by 0.18. And that's our annual amortization rate for the automobile. So that should be amortization done. There's no other long-term assets that need to be amortized here. So then we would move on. The next one is an insurance policy which had 21 months remaining on January 1st of this year. Well, this is the end of the year. So when you look on our starting trial balance here before we started this assignment, our prepaid insurance was $11,600. Well, it had already been prepaid. So we didn't add any more, and we didn't adjust it because we only adjust yearly. So we're in the moment when we adjust. So we have a year's worth to adjust. So if we had 21 months on January 1st, we've used 12 of them. So that means we have to go December 31st. There isn't 41 days. December 31st, we would go insurance expense, and we would credit prepaid insurance to lower that asset value. And the amount is 12 of the 21 months have been used up. So that's the proportion of $11,600 that's going to disappear, right? It's 21 months. Yeah. So it's 12 of 21 months, and that proportion is how much of the 11,000 has been used up. What are you doing? There we go. So that is our insurance expense, and we remove that value from our prepaid insurance. So we'll scroll down a bit, get some room. December 31st for our next one is going to be, we're done insurance now. Moving on. What's this one? This is interest. So long-term debt. So by now you should be able to know what short-term and long-term debt is. So take a look. Automobile accumulated amortization, that's our last asset. It's a contra asset. So there's our first liability. That's short-term. Salaries payable, short-term. Interest payable, short-term. HST accounts, short-term. Current portion, well, it's current. So it's short term. Loan payable, mortgage payable. There's your long-term debt. So you need the total of the two, which is easy to eyeball. It's just $64,600. And that's what you're going to pay 5% of, right? 5% of the year's ending balance. So then it's 64,000, these two, 64,600. So it's going to be interest expense. And you're not paying it, I don't believe. What did it say? Interest is not due to be paid until next month. So it's not cash, it's interest owing. So it's interest payable. And the amount again was $64,000, 10 plus 54.6. So it's $64,600. Oops, $64,600 times the interest rate, which is an annual number. And since we're adjusting for the year, we don't have to do anything to that number. So the interest is $32.30, and we're done that one. Check mark. Okay, so this one, adjustment information, supplies need to be, so we have $875 of supplies left. So since this is one of those accounts, a periodically adjusted account, what's in the supplies account in our books is what we started the year with, and any additions. So we have $1,200 in the account, but only $875 in the storeroom. So on December 31st, we have to adjust supplies with the supplies expense, and we lower supplies with a credit because it's an asset account, and the amount we lower it by is whatever will bring us down to $875. So the charge is not $875. That's what needs to be in the account when we're done. And that's merely a difference of $1,200 minus $875. So that's an expense of $325. That will bring us down to $875. All right. Next, December 31st. Okay, so this one, supplies, is now done too. The year end was exactly a quarter of the way through a pay period. no salaries have been paid yet, but on the next payday, we're going to pay $12,000. All right, so then that's obviously a salaries expense has been earned in this month, but it's not a payday, so it's going to be salaries payable. So an upcoming bill will be paid later. But to recognize the expense in this year, we have to record, it's a quarter of the way through the pay period. A quarter of 12,000 is just 3. So that's our salaries expense that we have to adjust for. Next one is for certain an account which you have made an allowance for will not be collected. So we've made the allowance. That's the key expression. So we've made the expense, written the expense, bad debt expense, or made the allowance. That's step 1. This is step 2, when we are certain we won't get it and we are going to erase it or write it off. In other words, write it off our books. And that step is where you remove the allowance you have made and you erase the accounts receivable. And the account value is 280. Just like that. Done. So this third last one here is telling you this is a classification adjustment. It wasn't covered in the lesson, but it's fairly straightforward. You just kind of do what it tells you to do. So it's saying that in the next 12 months, the debt repayments will total $1,100 and $3,800 for the loan and the mortgage, respectively. So if you recall, the difference between a current and a long-term liability was current liabilities are going to be paid within the next 12 months and in full. That's what current is. But a portion of your long-term debt also gets paid every month, right? So in the next 12 months, this is the portion of the long-term debt you have to pay. So in other words, this debt is actually current, even though it's long-term debt. So you've got to transfer it. And what you do is you remove it from the loan. So you're going to have loan payable and mortgage payable and their liabilities. So we're going to debit them to lower them. So you're lowering the loan by $1,100 and the mortgage by $3,800. But the value, you're not paying it. You're just transferring it into another liability account called current portion. And that's a current liability. So you essentially move debt from the long-term section of the balance sheet and put it into the short-term section, short-term debt section, right? It's merely for presentation purposes so that users of your financial statement have more useful information for decision making. So they have a good idea of the debt that's coming up quickly. That's important, right? For your ratios and your analysis. So that's done. The second last one is bad debt. So it says historically 1% of credit sales have turned into bad debt. And this is an accounting firm, if you go back to the instructions, right? It's an accounting firm and nobody, brings a wad of cash to their accountant. They get an invoice, they get a bill. So it says all the firm's clients are billed, which means all the sales are on account. So if we go back to our starting balances, we look down here, we see our revenue for the year was $200,000. So all of that would have been credit sales. So fees earned $200,000 is credit sales. And 1% of those are expected to be bad debt just from our past track record. So we'll go, this is step 1. This is making the allowance, right? Because we don't know if we have bad debt, but we are adhering to gaps, to accounting principles by making an allowance based on what normally happens. So we go bad debt expense and we credit the allowance. This is the first step of a 2-step process for bad debt, right? And it's 1% of 200,000, which quite simply is just easily, right? It's just $2,000. And that's the second last one. And the last one is determining that an overdue account totaling $792 is uncollectible and should be written off. Written off is step 2. Also taking place on December 31st. So this is where you would then remove it from the allowance and you would credit the accounts receivable to erase it. And the account is actually $790. That's what was owing. And that's it. Those are all the adjustments you have in 27. But we will now move on and you can see we got perfect. All our account names are right. Our counts are right and all the numbers are right and they're on the right side. So we're done. So we can move on to do the income statement because if you look at the instructions, it wants you to do the income statement and the balance sheet. And the reason is you have a whole lot of new accounts because of adjustments and sales taxes too, for that matter. So we need some practice. And there's something that is now changing on the income statement. Okay, so we have revenues. And our revenues, and this is where we need to get rid of this side panel. We need our current balances, so we now need to go to our post-adjusting information, which will produce our current trial balance after all of our adjustments. So our revenues are down here. And we're at the stage in the course where we're not posting anymore manually. That's done automatically. So our fees earned is still 200,000. So we're going to go fees earned, and I do not want that italicized. And that is $200,000 done. And we don't have any other, but we still, on these files, we still need to go total revenues, and that is clearly $200,000. Piece of cake. We'll leave a space. And now we have a change. Businesses classify, and we're introducing it. We don't get very complicated in grade 11. In grade 12 you do, but in grade 11 we're just introducing the notion that not all of the revenues and not all of our expenses are actually classified the same. The main ones that you incur to run the business that you created your business to do. So this is an accounting firm. So providing accounting services is the main revenue source, and the expenses related to earning that revenue are your operating expenses, right? And there are some things that are not operating expenses. And those, in this course, essentially the only things that you'll encounter that are not operational, in other words, for an accounting firm, that are not the main expenses to drive your main business, would be things like interest on debt, because that's the cost of borrowing, not the cost of generating accounting services, and losses or gains on disposals of assets, because you're an accounting firm. You're not in the business of selling off your assets. You're in the business of providing accounting services. So anything that is not either under the discretion of management and is not part of your main business, either for revenues or expenses, are non-operating revenues or non-operating expenses. So everything else goes under operating expenses, and for the most part in this course, just interest and capital gains or losses are your non-operating expenses, and they come after operating expenses. So you'd have operating expenses, which would be auto, comes out. So you put in automobile expense, and it doesn't need to be bolded. And then you'd put in bad debt expense. And yes, that's not a decision. Well, it kind of is a decision of management, right? Because it's an allocation, but it's part of the cost of selling stuff on credit. So it's part of operations. Delivery expenses for paperwork and contracts and stuff. And then we're going to skip over here. I'm just going by this list, right? We're going to skip this loss and disposal of fixed asset because, well, that's a non-operating item. So then we have salaries next. And then we have insurance. And then we're going to have utilities. And then we're going to have not interest, but supplies. And then we'll put on obviously the values. I think you can handle that. So I'm going to skip that part because that's really no different. It's just the classification that's different. So then you would total, it would not expenses, but total operating expenses, right? And make it bold or make it italics, right? Because something else that's now being introduced at this point in the course is marks for format on both balance sheet and income statement. Right? So remember format. Next, another space. And now we have non-operating expenses. Again, bold. We have two, and we'll put them in this case, right? We have interest down here, and we have loss on disposal of fixed asset. So we'll do it. It's still alphabetical order. So it's loss on disposal of fixed asset. Whoops. And that's out of order. Why is that out of order? Isn't that interesting? Anyway, should be interest expense and loss on disposal of fixed asset. And then again, you got to total the non-operating expenses, italics, put your total there. And then the last thing, of course, is net income. And it's not this one, it's not this one. These go on the balance sheet. I see that mistake a lot. It's net income or loss. And you should bold it too, because it's also a major title, right? It's the final line. And that's how you do the income statement. Let's take a quick look at the balance sheet for classification. I'm not going to do all of it, just the first part so that you get the idea. So the title and stuff will be December 31st for the date, and then you'll put the name of the company balance sheet. That much you know. And you put assets, and then you put current assets. And again, you're getting marked on format, so make these look different than account names. And the first one is cash. And the next one is going to be, make sure we actually pick cash, and then it's going to be accounts receivable. And I'm going to actually put in the numbers here. We'll go right up to the top, and you'll see that cash is $63.75. So $63.75. And the next one, I make sure my format's looks the way I want it to. I want it to be financial. And the next one's going to be accounts receivable, 11,208. And here's where we get into the new accounts for adjustments. Allowance for doubtful accounts. Notice it's a contra asset, right? So it's a credit balance. You can't put negative numbers in the journal. That's what debits and credits are for. There's no negative numbers here, right? This is subtracting from assets. It's a credit balance, but we don't put a negative side on the debit. We use credits. And the same with T accounts and ledger accounts. And the same with the trial balance. There are no negative numbers on any of those. But the financial statements are not internal accounting records. The income statement and the balance sheet are shown to the public, and the public does not know what debits and credits are. So you present all numbers as positive values, unless they act in the opposite way to all the other numbers that they're surrounded by in their subgroup, in their subcategory. So for instance, in current assets, you're going to have the allowance for doubtful accounts. You're going to have supplies. You're going to have prepaid insurance, right? There's your total current assets. And that should be italicized. Our allowance for doubtful accounts, so let's put in supplies. So $875, just like it should be, we dropped it down to $875. Our prepaid insurance is $4,971.43. And our total will be all of this added up once we get the allowance in. But what we have to make sure we do, we have to make sure that we put in this value the way it's supposed to be shown. So the allowance for doubtful accounts is $1,361. But if I put in $1,361, it's going to be wrong, right? Because it's a credit balance. It's different than all the rest of these. These are all debit balances as assets, and this is a credit balance. And it'll be the same for all the accumulated amortization, right? You've got to show it as having an opposite effect, and you do that by making it negative. So all the contra accounts, whether they're liability contra accounts or whatever, if they're all opposite to what's around them, they have to be shown as negative like this. And with that info, you should be able to complete this process now. The whole exercise. Give it a shot.